Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Today, we are going to talk about how interest rates affect the housing market.
Right.
There is this sort of misperception out there that when interest rates go up, home prices go down because it wipes out the buyer pool. People all of a sudden can't afford to buy. That is true to some extent. Mm-hmm. It does take out a few buyers. People who are buying, they're right on the cusp of qualifying, and now the interest rates go up, and you say, oh, they can't buy anymore. But
right. But it also brings buyers in.
Okay.
So for the buyers that it takes out because they simply can't afford it anymore, buyers that were on the fence that say, you know what, if I don't buy now, I won't be able to buy when interest rates go up another half a point or whatever it is. And it brings in the buyers that say, you know what, I'm going to buy now, and I know interest rates will go back down, and then I'll refinance. You know, one of the things that somebody said to me very recently is most of us fall in love with the house that's perfect for us 2 years before we can afford it. So this is not an atypical situation. We know, and I've said this before, you know, we have beer budgets and champagne tastes, right? So that means that we stretch ourselves to afford that house, whether that means the price of the house or whether that means the interest rate, knowing that our income or circumstances will change over the near term and things will get more comfortable.
Okay, so this is what we did. We went and did some research, and we looked at every times in history interest rates went up over 1.5%. Now, we actually only went back to the 80s because if you go back to the 70s, you have high inflation and everything went up, including home prices. So it's not necessarily super informative. So this is what we're going to look at. This is a chart I made. I'm going to go and put it up right there. Okay, there's 2 lines on this chart. Well, there's actually 3. There's the blue line, the red line, and the black lines. So the blue line are home prices, right? And you can see on the right scale, that's the price of median price of homes in the U.S. This is the whole country, okay? Now, the red line is the 30-year mortgage rate. We just picked one and went with it because that's the most common one. And then on the left-hand column there, you see the numbers from 3 at the bottom and then 19 at the top. Those were the interest rates during that time frame. Now, the black lines correlate with the bottom line, and the bottom line are years. So what we did was we looked at every time interest rates went up over 1.5%. So we'll go to the very first one. So if you go look at the very far left side, you see that interest rates were about 9% in 1987, and they went up to 11% in 1988 or 9. So over a couple years, interest rates went up 2%. But then home values went up still. Matter of fact, they went up quite a bit. Now, you notice that after they went up, home prices kind of chilled out a little bit, but something else happened there. Big recession. Remember that? The Desert Storm, George Bush, the first recession we had. We were in a recession for a while, and it lasted into the first few years of Clinton's presidency. So there were job losses and stuff, so the housing market sputtered. But if you look at interest rates went up and home prices went up. Mm-hmm. They went up. And part of the reason they went up was we had a little inflation during that time, and home prices chased inflation. So what's counterintuitive here is that home prices should decline, but they didn't. They went up anyway.
Right, because when you have inflation is one of these things that affects home prices, yes, but it affects home prices by having home prices rise with inflation. It's kind of this thing that happens like with everything else, right? So when you have inflation, you have gas prices that go up, you have home prices that go up, you have these staples that go up, and homes are one of those.
Now, if you look at the next 2 set of lines over, you'll see that the interest rates just fell to 7% because the Fed was trying to get us out of this recession, and the home prices didn't really go up, which is counterintuitive. You would have been like, wait, if mortgage interest rates going down should help the housing market, but they didn't really help it because people still didn't have jobs and stuff. So what happens is they went down and then they went back up again, but that's when home prices started to go up, and you're saying, but it's lagged. There's a lag. But there's not that much of a lag because interest rates almost instantly change when the Fed changes rates. Mm-hmm. And there's only a 30 to 45 day period between interest rate changing and people buying houses. Mm-hmm. Now, an argument could be made that people were waiting for interest rates to go down further. But as you can see here, that would have been bad because when they hit 7, they went back up to 9 by the mid 90s. But what happened during that time? Home prices did still kept appreciation, keep appreciating. Okay, and then we'll jump to the next one, which is just before 2000, in the late 1990s. Well, what happened was interest rates went up again. They went up from about 6.5% to 8%, but home prices went up fairly nicely still. They went up, median home prices probably increased $15,000, $20,000 during that period. So it didn't negatively affect the housing market. And then if you look at the last time interest rates went up, which was the very last time they went up, we'll call it 2003 to 2006, a 3-year period, they went from 5 to 6.5%. And what happened to the housing market? Blew up. It kind of home prices kept going up. And then if you go to the right of that, when you see, that was where we'll call it the bubble, the crash. Home prices came down, but also interest rates came down too. Why? Because we were in a recession and they were trying to get the economy to go, so they were lowering interest rates. So here's the moral of the story, I think. We're going to talk about this in detail, but this is my overall belief. There is not a lever that you push on that one for one affects the housing market, like interest rates. That's what everyone's saying is interest rates. If you move the lever, interest rates change. Because there's other things, Juana, right?
Right.
Recessions affect it, inflation affects it, things like that affect it.
Right. And housing is a different animal than maybe other sectors of the economy. Because housing is something that everybody needs. Housing is something that everybody wants. So kind of to my point earlier, people say, well, if interest rates are going up, I'm going to go ahead and buy a house because as interest rates go up, that house is going to be less affordable for me. Interest rates going up also make investors want to buy homes because they're thinking, well, inflation is going to happen, so then I want real estate as part of my portfolio as a hedge against inflation. So there are all kinds of reasons. When interest rates go down, what you see is those people who purchased back when interest rates were high, they're refinancing. So they're refinancing, they're maybe pulling some money out, or they're freeing up cash from their monthly budget. And then you see them coming back into the market and participating later, whether it's to purchase their step-up home or to purchase an investment home. So you see that sort of thing. So it is a lot more complex than, as Todd said, the seesaw effect where interest rates do this, housing does this, or vice versa. It is a much more complex environment, and you have to look at the whole environment in order to understand what's happening.
And if you look at it from a psychological perspective, and you all as being emotional humans that are watching this video, if you want to buy a house because you just love the idea of owning a home and you're going to live there, you're going to buy the house. You're not going to care what interest rates are. You will rationalize it. Like Juana said, it's okay that interest rates are high. I know this is going to be kind of expensive for us for the next year or two, but when the interest rates go down, we'll refinance.
Right.
I know people that bought homes at like a 4% interest rate that literally they just went to 2.75 and I refinanced. And when they bought at 4, they were fine, but they just see they can put more money in their pocket, so they refinanced.
Right.
The other thing too is people don't stop buying. You're like, wait, but what about that person who's right on the cusp of buying that house they've always wanted, but then the interest rates go up and now their debt to income ratio doesn't work? They buy, but they just buy a smaller home, meaning all that debt to income does is, instead of being able to buy a $450,000 house, they can only afford a $400,000 house. They go, okay, fine. Let's reevaluate, and let's, instead of buying the 4-bedroom with the pool, let's just go buy the 3-bedroom in this other area. We'll live in it first, and then in 4 or 5 years, when we make more money and interest rates go down, we'll buy the big house that we want, and then we'll just use this. We'll keep this as a rental.
Exactly. So, like I said, it's much more complex. And to Todd's point, we are emotional creatures. We do fall in love with, whatever house is just beyond our reach. And sometimes we stretch and we maybe cut some other things out of our lives so that we can afford that house, or we kind of reevaluate between our wants and our needs and step back and purchase our needs rather than our wants. But either way, people that are in the market to buy most of the time will go ahead and buy. Yes, there are those who will go ahead and fall out of the market, out of the buyer pool for a while, but most of them will continue to move forward and purchase something.
And we do hope that this puts a dampening effect on real estate values and that they don't keep going up like they have been, because of course you can't just go up at, if the economy is growing at a certain percent and there's inflation at a certain percent, home prices can't go up at 20%. They can if there's this disequilibrium and they're just catching back up to where the market feels they should be. But keep this in mind too, when you think about interest rates specifically. Interest rates only affect one class of people getting loans. If you're a cash buyer, all you look at is the price of the house. You don't care about the interest rates. Really, you don't care about the interest rates because you're not getting a loan. You're not subject to the interest rates. You may be looking as, well, what other things can I do with that money? Stock market or bonds or crypto or other asset classes. But if it's residential real estate and that's where you're going to put your money, that's where you're going to put your money. The other thing is too, let's say you're getting a loan. What if you have money though for down payment? You don't really care that much about interest rates because it just means I now have to put just more money down. And there are a lot of people that have fat retirement, 401ks, or that have saved and they're just like, I can put 50% down. I don't need to get that big of a loan. This is not like it used to be where you had to get, if you didn't have the 20%, you're doing FHA loan, you barely could buy a house.
Right.
Incomes are such the way where that the prevailing interest rates, and even now almost 5%, they're like 4.76%, is still historically ridiculously low. I mean, literally at no time before 2006 maybe were interest rates this low. You couldn't just go get a 4% mortgage,
right?
More than a decade ago. And we're not talking about the 3-1 arm you got, which was a problem, right? Remember the 3-1 arms that caused a crash in it? That hurt the housing market because all these people are overbuying a house on a 3-1 arm, and then interest rates didn't go down like they were promised, and then the mortgage payment shot up, right? These are 30 years fixed mortgage rates.
Yeah, and kind of to that point, also people have, and we've talked about this before in previous videos, Americans right now have the highest savings rate they've ever had. We have the most money available to us to use for down payments, and of course the higher your down payment, the lower your overall payment is, your monthly payment is on that property, so that interest rate going up a quarter point or half a point is not as painful because you can mitigate that by putting more money down.
The other thing too is if you don't own a house, you have to rent a house, and rents are going up too. So now you're stuck in this thing of you need housing. Do you pay for a rental, which is not cheap, and it's going to, every year you're probably going to get a rent increase, or do you just go into the housing market? And that's another thing that a lot of people aren't talking about is, everybody who's watching this video probably is renting or they own their home, or you live with somebody, right? That could be a third one. But the person you're living with either is renting or owns the home. So you make these economic decisions, and sometimes people go, just, what, my rent is $2,200. Matter of fact, we ran into somebody recently who basically said the reason I decided to buy a house was I wasn't going to buy a house. I wasn't even interested in buying a house. But I only made the decision when I realized I could still buy the house and have less of a monthly payment all in than I would paying rent, and I would build equity. And they said, for me, it just made sense to buy the house. And that was fairly recently. And even with home prices up, it was still made more sense to buy than rent. So bottom of the line, moral of the story is interest rates going up do not destroy the housing market. They don't cause a crash. So when you're watching those other videos that get 1 million views where they're convincing you the market's going to crash and it's going to cause all these problems, this chart shows that doesn't happen historically. It's never actually happened because, remember, interest rates are going up because of inflation's going up or the economy's too hot, right? So, and they're trying to cool it off. And so that means when those two things happen, home prices are going up too.
Right, and so are rents.
And rents are going up.
So if rents are going up and home prices are going up, you still kind of have the same dilemma, right? Do I spend my money on rent or do I spend my money on a mortgage payment? And for a lot of people, it makes more economic sense to spend that money on a mortgage payment because they're building equity, there's a tax deduction, there's just the emotional aspect of it, of being able to own something rather than being subject to somebody's whim who might sell the property and then you have to leave, and all those sorts of things.
Here's the other thing. If the home of your dreams was going to be $400 more a month, you would still buy it, because A, you believe that in a couple years you would earn that money more in income and you could be comfortable making the payment, or you would just suck it up for 2 years and wait for interest rates to drop again when the economy goes into a recession and they have to start dropping rates to get the economy moving again, and you refinance and now you have a lower payment. Look, everyone's thinking these things. So please, the reason why we showed the chart and why we're giving you these anecdotal and things that actually happen is because it's not fair to say interest rates going up are just going to collapse the housing market or stop the housing market or destroy the housing market. There's no proof that actually happens. It doesn't happen.
Right, and it's just one piece of a much more complex system.
Give us your thoughts. Like, what did you think? Was this video helpful? Did you think that we just made all this up? I mean, we're not pumping the housing market. Trust me, we would be totally fine if the housing market tanked again, like it did in 2007, 8, 9, 10. We'd go buy some more rental houses. We'd get a bunch of investors and all our friends to go buy more rental houses because we would put tenants in them and make a ton of money that way, but we're just calling what we see. We just did a market update video that we published a couple days ago. You can go check it out. But this is not this is not disputable information. This is indisputable information. The interest rates are not going up to cool off the housing market. Interest rates are going up because of inflation / what's going on in the economy in general. Those two things more affect housing than interest rates affect housing.
Absolutely.
So give us your comments.
Please give us your comments. We're very keen on actual information that is verifiable because that makes sense to us. And we want to know what information you have and what you think about all this. So leave us your comments, share the video, like the video, hit the notification bell, and we'll see you on the next video. Bye.
Bye.